Thanks for tuning into Talking Point today. I'm your host, Niraj Shah. Well, real estate is never a cold topic, but it's so hot right now simply because of the number of things that are happening, both on an individual developer side as well as on an industry-wide perspective. We've had a fairly large deal getting culminated. It was known, but it's finally culminated, and the ratios, etc., are out. I'm talking about Embassy and Indiabulls Real Estate. That aside, we've seen some very interesting models come up wherein companies are probably hiring or taking on rent flats and getting people in clusters to come in and operate out of those flats instead of coming to an office. And this could very well be replicated across the country, wherein people living in a satellite city can work for the office for a particular company without coming to that office as well. What does all of these developments, so what do all of these developments mean for the sector, and is it even possible to comprehend that? Well, maybe for you and me, it might not be, but Anuj Puri does that for a living day in, day out, and it's best to get in his perspective on all of these things and more. Anuj, so good having you. Hope all is safe.
Very good to be on your show, Niraj. As always, yes, everything is very safe.
Super. Anuj, just a brief bit on a large deal that happened, and then we'll get into the nuts and bolts of the industry. It's an interesting time for a deal of this size to be culminated because it just makes that combined entity so much larger. Any thoughts on the deal and on the large versus the small developer space at large?
I think, Niraj, it is a win-win for all the stakeholders in that deal. If you were to look at it, on the office side, the office assets move to the REIT. On the residential side, there is a reverse merger where Embassy, owned by Jitu Virmani, is able to put in his, stock of residential into the listed entity. And for the Indiabulls promoters, their main business is on the lending, on the finance side. So, clearly a very positive outcome where all the stakeholders really got what their objective was. I think, Neeraj, you're going to see more and more and more such deals. Here, the objective may have been very different because from Blackstone, Embassy REIT, they wanted the office assets. From just pure Embassy, they wanted a listed entity. And from Indiabulls, they wanted to focus back on the financing. But there will be a lot of deals that you will see, Neeraj, whether these are large asset portfolio sales or pure mergers, where it is going to be driven because of the financial compulsion.
Yeah. Grapevine tells me in the next 2 or 3 weeks, we might see a flurry of PE deals happening as well, Anuj. Uh, do you reckon these will be large in nature, or this will be piecemeal string of pearls kind of developments that we'll see?
So I don't think so. It is piecemeal, string of pearls. I think it is the full necklace that you're going to see will really get taken up because from the private equity they're saying is that we will take the entire portfolio, good, bad, ugly. We will come in and we will take it up. It can't be that I'm going to be as a developer only wanting to sell you the bad, apples in the cart. Nobody is there as a taker. But there are enough takers to say is that, we're happy to take the full cart and we're happy to do the full wholesale trade. And then we will sit down later and do what we think is a good one and what is not a good one. And because many of these private equity guys have a huge amount of appetite to be able to hold on, they will go through this entire pandemic and then 12, 18 months later start to sort out that what are the good apples and what are not good apples. But the not good so apples, they'll be able to sustain because they have the private equity has the liquidity to be able to continue sustaining those assets.
Is the larger landscape and the model of Indian real estate changing of sorts from an investor's perspective, Anuj? Because here, I mean, there has to be a reason why a bevy of private equity deals might be happening. I mean, there has to be a reason why these investors are invested in picking up these large assets, because these are not tiny tune 20, 50 crore deals happening.
So Neeraj, a very good point. I think there are 4 or 5 reasons why it is going down that route. One is that everybody is really wanting to focus on their core. And then core, we saw on the India Bulls, core was financing. Even in the developer world, you will see is that core is what they really want to focus. Is the core retail? Is the core hotels? Is the core warehousing? Is the core office? Is the core residential? There may be two or three cores that they may have, which they will continue to focus. The rest assets that they have built, they would say is that we want to get it out. Second is most of them want to delever. So, in the process of delevering it, they are being able to sell these assets to get in the money from the private equity to be able to then delever, pay the banks down, and pay down the debt. Third is that they are largely going back into the geographies that they are very comfortable with. And so they're consolidating into the geographies which they sort of know very well and are known in those geographies. They had expanded in other geographies. It's perhaps not making sense at this moment in time. And then, lastly, on the other hand, there are some assets which at this moment in time are being very painful. For example, the hotels, for example, the retail. Those are the assets that many of the developers are saying is we will need support, we will need help to be able to see through this, because until really the footfalls happen, until really the business traveler starts, until really the tourism goes on, retail and hospitality will continue to have some negative overview.
Okay. Interesting. And since we don't know how long that will last. Sorry, yeah, please finish your point.
I was just saying is that, in the larger picture, Niraj, I'm quite okay with this because, it will only mature the market. What is also very good, Niraj, is that, when the private equity is really looking to consolidate, or when, there is a player who's looking to consolidate, they're really not looking at this as a distressed deal. If this question you had asked me in April, I would have said as, there will be a lot of distress, acquisitions that are going to happen. I think private equity is really maturely behaving. When you speak with them, Neeraj, they are saying is we're just glad that these assets have come out into the market. We're just happy that these were crown jewels which we never thought would ever come out into the market. We're just glad that they've come out into the market. We don't really want to beat down the price. And that's why, Neeraj, you're seeing the deals also happening, because these are not at distressed valuations. That are going to larger players for the consolidation.
Okay, that's interesting. Part two, though, of my question, therefore, Anuj, would be that you mentioned about asking you in April, and I asked you in April, and the view may have been right there. I don't know whether your view has changed. You mentioned that there is a high probability that commercial yields will come off the cliff, because you cited a data in 2008 wherein US went through a tough time, and how the Indian rentals completely fell off because the occupancies fell off. Now, you believed then that that could well happen. Has it happened, or has it behaved slightly differently? And how does that augur for commercial rentals, commercial yields?
So, Neeraj, it is similar and yet a little bit different. And I'll tell you why the difference is to begin with. The difference is that this time, majority of the portfolio of offices are held by a very marquee investors, owners, developers who are very well capitalized. In 2008, it was very fragmented. As a result of which, they didn't have the holding capacity and they went down very quickly. This time, if you look at it, just grade A, the total stock in India, nearly 31% of it is owned by really pedigreed investors or developers. So, ability to be able to sustain this through is much better than what it was in 2008. Why it is similar is because the demand has come down. Demand came down in 2008. Demand in 2020 has come down. So we had said is that in our opinion, at the beginning of this year, there was going to be 42 million square feet of leasing activity in commercial. Last calendar year, 2019, it was 40. So we had thought it will go up to 42. We're now estimating that to come to 28 million square feet. So clearly the new demand has slowed down, and it is not surprising that the new demand has slowed down. America, the economy at this moment in time is really seeing what is going to happen there, and the large IT companies, the large financial institutions who are doing back offices in India are at this moment a lot more focused on the business. So you're still very positive to say 28 million square feet is going to be leased. It's not zero in there. So that is very similar to what we had seen in 2008, when it was before the global financial crisis at about 35 million square feet, and it had come down to 20 million square feet. Yet on the rentals, just because it is being held by very marquee investors, and also, many of these properties, if you were to look at the mark to market rent, the market rent has gone up significantly, yet most of the occupiers are largely on historic rents, which are 5, 6, 7 year old rents. And in the last 5, 6 years, we've seen every quarter the office rents going up between 1 to 3%. So really, when the occupier is looking at saying, should I go out and renegotiate with my existing landlord? They're looking that the market rent is here and we are really sitting at here. How are we going to really argue our case?
Okay. So just tell me though, the popular belief seems to be, Anuj, that commercial yields will come off from maybe the current ballpark 8%. And I don't know if my numbers are right. Please correct me if they are not. But ballpark 8% to somewhere around 6%. Do you reckon that could happen?
So Neeraj, we've started to see that happening already, and that's largely led by the interest rates. If you look at it, the interest rates have dropped dramatically, and that is where the yields are starting to follow. I won't say that Neeraj, there is a huge amount of evidence as yet that we have seen that the yields drop dramatically, but the trend is moving towards that direction. Each of these deals that we are seeing, they're probably 10, 20, 30 basis points lower than what it was at a pre-COVID level.
Got it. Okay. The other bit, and something that one of the market guests told me, and he said that some of his technology company clients or investee companies are doing this, wherein companies are now taking flats on rent in an area wherein maybe a few employees are living and getting them to work out of those flats. So it could well be in the same city where the head office might be or the operating office might be, or it could be from a completely different city because the lockdowns ensured that a lot of people migrated back home and therefore are working out of there. Now, one, do you see large evidences of this? And two, does it therefore alter the commercial versus the residential potential demand ever so slightly, or no, not at all?
Yeah, no, very good, very interesting point. So it is happening, but it's slightly different to the example that was quoted. So Neeraj,
Okay.
what is happening is that there is a lot of demand coming up on shared offices. In our parlance, it's called as flex office. So what these corporates, large IT corporates, just like what your acquaintance had said, is that they are saying we want an office close to where the people live, where our workforce lives. Prior to the
Right.
pandemic, we used to all come together. They will travel 1 hour, 1.5 hours to come to the head office, which was all consolidated in one large park or one building. Now they're saying is that, we want to be 20 minutes travel time from where majority of our workforce is. So they are accordingly going and taking shared offices, the co-working, the WeWorks, the office, the flex office spaces, and saying is, well, we need 30, 40, 50,000, square feet, maybe 200 seats, maybe 300 seats. And the reason for that is, many of the employees who are operating from home, they are going back to the corporate and saying, well, it's just becoming very difficult for us to operate from home, because they're probably youngsters, there are 4 or 5 guys who are sharing an apartment, they're finding it very difficult to be able to interact with the client. There's no reprographics there. Many don't have proper table, chairs, networking, availability. Many of the corporates are also a little bit hesitant on this security. So instead of taking apartments, they are largely going into the shared office spaces, the flex office spaces, but that's a big trend, what you have spotted out. Where we are seeing the demand come up on the residential Neeraj is that, the guys want to upgrade themselves. So, they want to move to a better quality building. They want to move to a larger space. Majority of the demand that we are seeing today is on ready to move in inventory. So again, I had, in April not expected this, that it would come back so quickly. But because many of the guys have now been cocooned in their homes, they're saying is, we have the money. We were always looking for that, new residential space. The residential prices have come off in many of these ready to move in inventories. They are accordingly going and saying is, let's go ahead and do this purchase. We will move to a better environment, more secure, more safer. It has got more infrastructure, more facilities in a newer building, and hence we want to upgrade, but ready to move in inventory.
Okay, interesting. An offshoot of what I learned on air from one of the brokers, but nevertheless, it is interesting to know this. Okay, Anuj, last couple of questions. First question is an open one to you. You usually share some very interesting data points that your research team has dug out over the last 1 odd month. Anything which is really interesting that has stood out for you?
I think on the residential side, Neeraj, I'll say 5 or 6 things that has been pretty interesting. One, there has been a fair amount of demand from NRIs coming in. Second is, the clients, if they're shortlisting 10 properties, they are seeing those 10 properties virtually. So, it's really expedited the digital play in the marketing. And they are shortlisting 3 on the virtual tours and then physically going and seeing those 3. The conversion has doubled. So whilst the footfalls, the site visits are lower, but those guys who are coming in to look at buying that residential, there is a 100% improvement than what pre-COVID level percentages were. And this is interesting. Even my retail team was telling me yesterday is that most of the malls, they're getting 20% of footfalls to pre-COVID level. Yet the revenues are about 40% of the pre-COVID level. So whoever is coming in is largely a serious buyer in there. We're also seeing on the residential space that the average age of the buyer has actually come down. It used to be sort of mid-30s to mid-40s. We're seeing it's early 30s. It's largely salaried people who are buying it. In the salaried also, the sector is IT, pharmaceutical, government. A huge amount of government employees who have come out into the market. Business guys are not coming in. The prices have come off between 5 to 20%. Luxury has been more and affordable has been less of price reduction, but the buyer is definitely looking at some discount to the pre-COVID levels. And we are hoping that the new launches needed will start as the festival period, starting from tomorrow, goes on. And till now, we've not really seen new launches. If you were to compare the April to June quarter to 2019 versus 2020, we are 97% off the new launches. And again, it's not a surprise, but I'm hoping that this quarter, before September ends, we will start to see the new launches and the pace pick up. Finally, I would say, Neeraj, that the market will get very consolidated. We're starting to see that with the private equity. We will see that private equity largely on the listed residential or on the office side, but you will see even on the residential space, non-listed, that there will be consolidation that will take place.
Okay, final question, Anuj, and that is on the 2 things that are being spoken about, right? Stamp duty or ready reckoner rates. And I think the debate around ready reckoner is that there are people who believe that ready reckoner rates cutting down will help because the final product rate and the ready reckoner rates are very close. In certain areas, they are poles apart. So even if the ready reckoner rate were to be reduced, how does it eventually matter? Which side of the argument are you on both of these? Stamp duty, ready reckoner?
Yeah. And so, Neeraj, if you were to look at China, the residential sales have really bounced back to pre-COVID level. And one of the things that they have done is this stamp duty. But it is only for a finite period of time. And I think that is what the request is to the state governments to say is, can you please reduce the stamp duty up to, say, 31st March 2021? I think the ask is not that forever that this stamp duty needs to be reduced. We're just saying is, let this momentum get built up, do whatever is required to be able to prompt the home buyer to get excited to be able to buy. So for a limited period of time, try and see if you can bring down the stamp duty. If there are deals that are going to happen, the government will have the revenue come through in the stamp duty. If there are no deals only that happen, it doesn't matter if the stamp duty rate is high or low, there is going to be no money that is going to come in. On the premium, you're absolutely bang on that this will positively impact on the pricing. And there was a bit of a dichotomy where the market was much lower than where the schedule for the premium payments were being done. I think it is just a realization by the government in Maharashtra to say, look, the market has come off, and we've been talking about it for a long time, Niraj, that the market has come off, and we will have to bring in these ready reckoner rates to the market so that the premiums are accordingly being paid by the developer and not artificially at a much higher price.
Okay, let's wait and watch what happens and how. But Anuj, take a moment to thank you for joining in and giving us some thoughts around what's happening around the industry. Appreciate your time.
Thank you very much, Niraj. Always a pleasure.
Stay safe, Anuj. And viewers, thanks for tuning into this leg of the Talking Point.